We have seen strength in stocks this morning, but of course, recession fears are looming over the market. Our guest says that massive full percentage point hike by the Bank of Canada may have been overdone. We're joined by Kristina Hooper, Chief Market Strategist at Invesco. Kristina, thanks very much for giving us the time.
Thanks so much for having me.
Can we start off with the Bank of Canada? You think that they may have been just a bit too brutal in removing stimulus?
They may have been. I understand the logic in it, right? Front loading does make sense. And really, that's what the Fed is doing as well. But I wonder if just as much could have been achieved with a 75 basis point rate hike. Now, having said that, inflation expectations, longer term inflation expectations, actually rose recently in Canada, which I know presents greater problems, whereas in the U.S. we actually saw a decline in longer term inflation expectations. But it still could be very startling and be a bit much in terms of the Canadian economy being able to weather it. But it all depends really on the path that the Bank of Canada takes now and just how data dependent it is.
Let's look at areas you think are promising for investors. The tech sector, many of those tech stocks beaten down. You think there's value there?
Absolutely. Again, one needs to have a longer term time horizon, really for any ideas in the equity market. I mean, we need to be looking out at least 12 months because we could see significant volatility. We don't know exactly when the market is going to bottom. But it seems as though, especially given how front loaded rate hikes are, that there could get to a point where both the Bank of Canada and the Fed take a less aggressive path in terms of tightening, and that could be a catalyst to move stocks higher.
Interesting there. You see promise in China, but you are wary of their real estate sector.
Absolutely. There is a lot of promise in China right now. Two key reasons is monetary and fiscal stimulus, things that we're not seeing in Western developed countries, which are actually withdrawing monetary and fiscal stimulus. So that creates a more supportive environment for equities, for sure. Then, of course, we also have a regulatory environment that has gotten more business friendly in recent months. And, of course, the big catalyst should be a reopening post-COVID closedowns.
Healthcare. People still will get sick, whatever happens. And you say the healthcare sector, I think, are you mostly thinking about America here, the U.S. Healthcare sector? You say it offers some pretty decent dividend yields.
Yes, it does. U.S. healthcare looks attractive. There are areas like pharmaceuticals and biotech with very solid dividend yields, strong cash flow. Those are the kinds of defensive areas to focus on in the near term. But again, I do believe there could be a time where we see a bit more of a risk-on environment, and it shouldn't be too far in the future, actually.
But we're not there yet. You think people are?
We're not there yet.
You think people still are wary of because I mean, well, I'm trying to think. We had the COVID recession, but that was so unusual that it was such a weird situation. We haven't had a serious economic downturn in more than a decade.
No, we haven't. But having said that, we have gone through different phases, different shapes of the economy. And quite frankly, the recovery from the last very big downturn, the global financial crisis, was slow. It was rather anemic, especially from a jobs standpoint. There are no two recoveries that are the same, but I do believe that this time around, whether we avoid a recession or not, if we go into recession, it should be a mild recession. And I think we would have a quick recovery from either a slowdown or mild recession. And that could be a very different environment, especially since the labor market is quite good and really some fundamentals are still quite good.